Every single day in America, millions of people swipe their credit cards without thinking twice. For groceries, for gas, for online shopping, for things they need, and sometimes things they don't. It feels normal, but behind every single swipe, there's a financial system quietly working in the background, calculating interest, tracking balances, applying daily rates. And if you don't understand how this system works, you could end up paying thousands of dollars more than you expected. Not because you're irresponsible, not because you're bad with money, but because no one ever clearly explained how credit cards actually work. So in this video, we're breaking everything down: what a credit card really is, what APR actually means, how daily interest is calculated, why minimum payments keep people stuck, and how to use credit cards the smart way. Let's simplify this. A credit card is not extra income, it's not free money, it's a revolving line of credit, which means it's a loan. When you swipe your card, the bank pays the business instantly. Now you owe the bank. You're borrowing money with the promise to pay it back. At the end of your billing cycle, usually around 30 days, you receive a statement. That statement shows your total balance, your minimum payment, your due date, and your APR. From there, you have two choices. You can pay the full statement balance, or you can carry a balance and pay interest. That decision changes everything. Most credit cards offer something called a grace period. This is usually between 21 to 25 days after your statement closes. If you pay your full statement balance during this time, you pay zero interest. Zero. That means you can use the card, earn rewards, build credit history, and avoid interest completely. This is how disciplined users benefit from credit cards. But the moment you carry a balance past the due date, interest starts building, and that's where APR comes in. APR stands for annual percentage rate. If your APR is 24%, that means you're being charged 24% annually on any unpaid balance. But here's what most people misunderstand. Interest is not applied once per year. It's calculated daily. The bank takes your APR, divides it by 365 days, and applies that daily rate to your balance every single day. This is called the daily periodic rate. Let's make this real with an example. Imagine you owe $5,000 on your credit card. Your APR is 24%. 24% divided by 365 equals roughly 0.065% per day. That might sound small, but every day interest is added to your balance. And if you don't aggressively reduce that balance, the interest keeps stacking. Over a full year, that could mean around the $1,200 in interest alone. That's money you're paying just for borrowing. And here's something even more important. Interest compounds, which means you can start paying interest on interest. That's how debt quietly grows. Now let's talk about the minimum payment. Every statement shows a small number labeled minimum due. It looks safe, it looks manageable, but here's what's happening behind the scenes. Most of that minimum payment goes toward interest first. Only a small portion reduces your actual debt. If you only pay the minimum on a large balance, your debt shrinks very slowly. You stay in debt longer, and you pay significantly more over time. Minimum payments protect your account from late fees, but they don't protect your long-term finances. This is how many Americans stay stuck in credit card debt. Not because they don't earn enough, but because they don't understand the math. Now let's talk about how credit cards affect your credit score. There are two major factors. First, payment history. Always pay on time. Even one missed payment can damage your score. Second, credit utilization. This is how much of your credit limit you're using. If your credit limit is $1,000 and you're using $900, that's 90% utilization. High utilization signals higher risk. Most financial experts recommend keeping utilization below 30%. Lower utilization shows control, and control builds a stronger credit over time. Now here's the bigger picture. Banks make money from credit cards in three primary ways: interest charges, late fees, and merchant transaction fees. The system isn't illegal, it isn't hidden, but it is designed to profit from misunderstanding. Disciplined users who pay their balance in full every month often pay little to no interest. Undisciplined users can end up funding the entire system. Credit cards themselves are not good or bad. They are tools. Used wisely, they can build credit, earn rewards, and provide financial flexibility. Used carelessly, they can create long-term debt. The difference isn't luck, it's understanding. If you understand APR, daily interest, grace periods, minimum payments, and utilization, you stay in control. If you ignore the math controls you. Financial stability doesn't start with earning more money. It starts with understanding how the system works. And once you understand the system, you can finally use it to your advantage. If this breakdown helped you see credit cards differently, subscribe to Wealth Forge Hub for more USA-focused personal finance insights. Because in today's world, understanding money isn't optional, it's essential.